And Nancy, great day to have you on. I know you've been very constructive on this trade, but just your reaction to see the sheer momentum that we've had since those lows back in April and your outlook for the rest of the year.
Yeah, thanks so much for having me, Allie. I think what investors can learn from this experience is you have to actually jump in when it feels the most painful. We were adding to a number of the chip names in April. We were adding to Tesla. It wasn't easy to do, but if you believe that the technology is real, and we believe it is, then you use volatility as your friend, as a long-term investor. So I'm surprised, but not surprised. I think we're due for a bit of a pullback. We may not get one, but we usually get a correction about once every 12 months. We had one obviously in April, but we've run pretty hard and pretty fast. That said, it's driven by earnings. I mean, this is not a speculative bubble as we saw at the end of the 1990s. And I've drawn the analogy to the 90s for almost 4 years now in a positive way. This technology, however, is much more robust than the internet was and eyeballs on a screen, which was how we were valuing companies back then. So I'm pretty excited. We still like many of the names, and we hold almost all of the names, I think all the names you had up on the screen.
So volatility is your friend. It seems like you would advocate to buy any dips, but since we haven't seen a ton of dips so far, how do you play this space and find the most attractive opportunities when a lot of names are really at these record all-time highs?
Yeah, so we've been broadening out. We just launched a strategy that is a macro cycle opportunity strategy. So think quantum, space, robotics, AI, and nuclear, the leading technologies that will take us through this industrial revolution. But remember, these changes, these transformative periods can go on for a long time. And historically, the market has been concentrated in the names that are driving the technology. So if you own them, you want to hold them. If you get a dip, and we do. I mean, we were buying NVIDIA at $108 a share back in March and April. We bought Tesla at $240 a share. You will get pullbacks, and that's when you step in if you don't own them, or if you do own them to add to it. They will not. I mean, the market doesn't go up in a straight line forever. So we will see some sort of a pullback, and that's when you really want to just get in there and add to some of these names.
So what are those specific picks for you, Nancy, outside of some of those mega cap tech players that you were just referencing?
Yeah, so we have a few for you today, Allie. I mean, we've talked about on your air for a long time, Broadcom is the poor man's NVIDIA. We still like it. It's one of the largest holdings in our ETF TGLR. We'd still own NVIDIA, love it. But one of the names we've held for quite some time and we think has a ways to run is Lam Research. So think global supplier of wafer fab equipment. They are dependent on memory, which had slowed, and now the cycle is beginning to pick up. Not just in memory, but NAND in particular. So cycle is beginning, and they grab about 2/3 of the NAND market. TSMC is one of their largest clients. Stock's up 100% or so this year, 102%. But you're getting paid a dividend that's yielding about 7.7%, but growing at 15% annualized over the last 5 years. So you are getting paid to wait for the company to continue to perform. That's one of the names in chips that I don't hear a lot of people talking about. Another name in our new strategy is Symbotic. They are a robotics company that has really developed the back office of Walmart. Now, the downside is Walmart is 85% of their revenues, but the upside is they've been expanding their client base, and the CEO put in 800 or 700 million of his own money. So one of the important things I think to note about all of this is we've talked about Walmart as the poster child for old economy companies pivoting. The first customer to buy Symbotic software was Target, and then they decided not to go through with it. Walmart did, and you can see the difference in the stock price performance.
You've also flagged Spotify as a top pick, and we did get some news this week that they're going to be shifting to a dual CEO structure, similar to what we see with Netflix. Daniel Ek will be moving into that executive chairman role. What makes you so bullish on Spotify, and what's your reaction to that leadership shakeup as well?
So I think the leadership shakeup, Allie, was pretty well known. I mean, the two gentlemen, Soderstrom and Nordstrom, became co-presidents a couple of years back. This has been telegraphed. Eck is saying he's going to stay actively involved and be a European-style executive chairman, but they have room from a pricing standpoint to continue to grow. Monthly average users is expanding. It has run hard, and we have trimmed back our holdings, but it is still a member of our 12 best ideas portfolio, and we just continue to like it. I mean, if the economy slows, this is a company that continues to drive growth because it's kind of the last thing people cut, like Netflix in their budget. So we do still like the company. I wouldn't chase it here. I'd again wait, but we're holding on, and as I mentioned, it's in our 12 best ideas portfolio.
So how do you know when to trim back when stocks have run hard? Because again, we're in this environment where we just keep seeing higher highs.
Yeah, no. So if you're a retail investor, you don't necessarily need to do what I do because every sale has been a bad idea or trim because in a bull market. And so, but as a portfolio manager for institutions and large families, we have a commitment to not let the market make our asset allocation decisions. So, think Apple, we acquired it in 2013. If we had not trimmed it back, it would have been 15-20% of our portfolio at one point. So in the interest of diversity, we do trim back, but we run very concentrated portfolios, Allie. We have the 12 best, and then in our large cap strategies, it's max 30 names. So we do the research, and we make our decisions and overweight decisions based on the fundamentals and valuation to some extent. But it's the same with a name like Tesla. We have trimmed it when it got to current levels, but then we've bought it back. Generally, though, our core position has remained constant.
And there's been a lot of buzz around private markets after that $500 billion OpenAI valuation. Is private AI exposure something you've ever considered, or would you prefer to stick with those public names that have a bit more liquidity and you more disclosure as well?
Well, shout out to EquityZen. They've got a great model where you can go into their fund and they own actual shares in these private companies that, and the liquidity is, it provides liquidity for some of the insiders, which is a pretty cool concept. Think if you're in a company that takes 10 years to go public, it's great if your valuation, the stock valuation has quadrupled, but if you can't realize any of that benefit, it's not so good. So it's a win-win for the insiders and a win-win for private investors. We are in the process of starting our own fund through EquityZen in order to be able to offer those shares to our clients. And the names I'm excited about are XAI and SpaceX, and of course OpenAI. But it's a new area, and I think it's matured enough that retail investors can get in.
Yeah, exciting time for a lot of investors right now. Nancy, thank you so much. Appreciate your insights as always.